Bring in show music, please.
Hi, I'm CNBC producer Katie Kramer. Today on Squawk Pod. To cut or not to cut, the U.S. economy is digesting middle-of-the-road inflation data. The president is taking on the Fed chair, and we're debating interest rates with the vice chairman of IBM and Trump 1.0 veteran Gary Cohn.
If someone said, what would you personally do, Gary? I'd probably lower interest rates a little bit. I'd lower them 25 basis points and see what happens.
And the Acquired podcast, 3, 4, 7-hour conversations on the ins and outs of the world's most influential companies. Interviews with CEOs like Howard Schultz and Jensen Huang. Host David Rosenthal on how it all began.
We had a few hundred listeners and we were like, this is fun. And somehow it became this.
And host Ben Gilbert on how they built a brand with 1 million listeners an episode and millions in revenue without marketing at first.
When there's the right piece in the right publication with massive reach, it's game changing. Nothing has ever changed our business the way that a Wall Street Journal piece had.
Plus, New York's Democratic mayoral candidate Zohran Mamdani is meeting with business leaders. Crypto legislation hit a snag in Congress. And could your 401k end up with private market holdings?
What concerns me about it is just how educated 401k retail classes, which hopefully are watching our show. No.
Hopefully you're watching our show because we think you're dummies.
No.
It's Wednesday, July 16th, 2025. Squawk Pod begins right now.
Stand Becky by in 3, 2, 1. Cue it, please.
Good morning, everybody, and welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernan and Andrew Ross Sorkin. We did get a big pop in shares of Nvidia, and that helped power the NASDAQ to yet another new high yesterday. But you did see both the S&P 500 and the Dow a little bit weaker yesterday, and the Dow Transports and the Russell 2000 had their worst day since May. Checking out what was happening in the Treasury yields yesterday, the 30-year and the 20-year both had hit their highest yields since May.
Meantime, check out how Bitcoin and other cryptocurrencies are trading this morning. Let's show you what exactly is going on, because Bitcoin fell yesterday originally when the White House effectively was blocking prices of crypto legislation from coming to the floor. A group of Republicans and joining Democrats on the effort, which would have set the terms for the debate over the Genius Act. That bill, of course, meant to help regulate stablecoins. Then later in the evening, President Trump posted on Truth Social that he was meeting with a group of lawmakers who he said had agreed to vote for the rule in the House. He said that House Speaker Mike Johnson, quote, looks forward to taking the vote as early as possible.
In more Nvidia news, the CEO Jensen Huang is in China for the second time in about 3 months. Today, praising the country's AI ecosystem. Speaking in Beijing, Huang called models from companies like Alibaba and DeepSeek world-class. This comes after Nvidia said yesterday it expected to resume shipments of its H20 AI chip to China after getting assurances from the U.S. government. Huang said the U.S. is processing those licenses for Chinese customers right now. Here he is speaking about export controls.
Export control are things that are outside of our control, and it can be quite disruptive to our business. It is our job only to inform the governments of the nature and the unintended consequences of the policies that they make.
A few other key lines we're grasping here from Jensen Huang. He said he told President Trump about his trip to China, to which Trump replied, "Have a great trip." He also spoke with the Chinese vice premier, and it was a wonderful meeting.
I don't know if you saw David Sachs yesterday on television, and then he made some other comments.
It must have been a later show because we've begged him, and it's too early for him to get up to come on Squawk.
David made an interesting point just about why the U.S. might be willing to do this, given the national security threats we're talking about.
Right? Yeah.
I think it's pretty important that we actually compete and take market share away from Huawei in China. Otherwise, we're basically creating a huge subsidy for Huawei in China. We're giving them all of that market. We're giving them all that revenue to fund their R&D, and we're basically creating a developer ecosystem for them. So I think we don't want to sell China our latest, greatest technology, but I do think we at least want to make it a little bit difficult for Huawei here. We do want to sell them a deprecated chip so they don't run away with that huge part of the market.
That it was more that Huawei doesn't have chips yet that are nearly as good as Nvidia's. However, what they have figured out how to do is effectively daisy chain their chips together so that they can create a sort of pseudo-competitive product, meaning the actual chips are not nearly as good as Nvidia, but if you put them all on like a server rack together,
Buy 100 of them.
you can sort of actually recreate what Huawei or what Nvidia does,
right,
or get closer to it. And that if they were allowed to continue to have success sort of approximating what Nvidia can do, even though it's not as good unto itself, that they may actually be able to move the price of that so far down that they could then start selling that product.
So they'd stop doing that if they could get
elsewhere.
It would be an actual competitive
They'd stop
threat.
doing that if they could get.
And the one thing we don't want to lose out on are chips and AI. We don't want to lose in that race to China, and that's been a pretty effective argument.
But even though, you can't have your cake and eat it too. Either China doesn't get good at AI, or we help them get good at AI, and then we'll have to deal with that cross that bridge when we come to it. Is there another? Can we mix that metaphor?
Well, it's not a walk in the cake.
Yeah, cross that bridge.
Cross that cake when you walk through it.
When you walk, yeah, cross that bridge. All right. Reports say New York City mayoral candidate Zohran Mamdani told a group of business leaders he would begin to discourage the use of the phrase globalize the intifada. That's big of him. Which is, he's going to now focus on from the river to the sea, which is seen by many as a call to violence against Jews. Mamdani was reportedly pressed by Pfizer CEO Albert Bourla at a meeting at Rockefeller Center hosted by the Partnership for New York City. It's interesting, those two were, didn't put those two names together necessarily. Yeah. Mamdani is expected to meet with more executives today. Reportedly in attendance were about 100 business leaders, including Lowe's Corporation Chairman James Tisch, the father of the current New York City Police Commissioner, as well as related companies Jeff Blau, Uber CEO Dara Khosrowshahi. People are now
I know a whole new people to Cuomo. The move towards Cuomo. So it's going to be very interesting to talk to them about
of that, yeah.
What's happening here, exactly.
That's
he
what we
has
heard
a
from
better
Ken Langone
Ken yesterday and others. There's a real sort of a, I don't know, panic hasn't, I guess it is setting in.
Oh, no. I think within the business community, I think there's a true feeling of panic. More, though, I have to say, I think around some of the anxiety around the anti-Semitism piece than even some of the sort of capitalistic or socialism pieces.
That's good and bad. I mean, pick your poison. I mean, that's awful. But just the notion that anyone still thinks that policies that are that far down the socialist path are in any way going to help this city is not living in the real world. Just like Jamie said, you're living in some la-la land. If you think all that free stuff is going to help anyone in New York. When things are free, you can't get them. When things are free, you can't get them.
The question is whether he can do any of these things, as we've
discussed.
He can't do them anyway. No, meaning...
Right,
Does he have
whether he has
over rent control? Because that's
the
one of
rent
the things
control
he was
is
talking
the
about.
rent control is one piece he does have control over.
Okay, so mayors can't do anything. You don't think the blah 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 was able to do anything bad in this city? He somehow found a way to totally ruin the city.
Rent control, you have the amount of officers you're putting on the streets.
I think,
there's a lot of
exactly. I think it's about police.
Yeah.
No, I know.
Right, there's lots of things you
around the edges. You can do plenty of damage.
Well, even the rhetoric can determine who's coming to the city and who's leaving, which is part of the issue.
Okay, folks, I want to know what you guys think of this one. So the Trump administration now working on a plan, a proposal really, to make private market investments more available to Americans through their retirement plans. This is according to a report in the Journal, which says that an executive order could be signed as soon, really in the next couple of weeks, but details still being worked out on this. Success in the area would amount to a huge win for the private equity industry. Shares of some of the key players, as you might imagine, rising on the back of this news. You got Apollo up about 2% this morning, KKR, Blackstone also up, Ares Management, and look, so much of the growth has come in private credit, also obviously in private equity. The question is this the bell for all of this stuff? I will say, what concerns me about it is just how educated, unfortunately, this sort of 401k retail classes, which hopefully are watching our show. No.
Hopefully you're watching our show because we think you're dummies.
No. But I just, broadly speaking,
I actually agree
folks
with you.
who whether they understand, especially around
the lockup periods,
these
they're
described as semi-liquid instruments, where
that is the concern.
For any private investment, you're locked up to some degree.
Look at the trouble that Harvard and Yale and some of the other universities have gotten into when they've been locked up with some of these long-term holdings. You think that they soar in value, but you can't get out of them. Right, you get gated on this stuff, you can't get out.
Having said that, if you have a child or you're in your 20s and it's a 401k with the plan to retire, hopefully in your 60s or 70s, the idea of being locked up shouldn't actually bother you at all, and maybe that's an opportunity. I mean, look, there's part of me that says that a well-rounded, diversified portfolio for most people should include private assets, should include real estate. I mean, you'd want people to have a diversified sort of piece of the puzzle. You're not supposed to be taking your money out willy-nilly. So there is something that's interesting about that.
It depends on when your retirement hits.
But you can create these target date things if you want. The other question I have right now, specifically for private equity, is private equity has not been, and private credit have not. Well, private credit's a little different, but private equity has not been returning money to people, in part because there's a real question about the valuations in the private market versus the public market. Nobody wants to sell to take down the marks. We've discussed all of this. And so right now, this will be a boon to the private equity firms. And who's going to be buying this stuff? I mean, on the exit side.
So you're worried about bag holders. But as an asset class, we always want to, it's just almost a cliche, we want to democratize the markets for everyone. And all asset classes go through bubble and they come in and out of favor, and long term, it's probably something that should be available to.
But I do appreciate your point of, is this a bell at the top?
Right. Or at least temporarily. I mean, maybe hopefully not forever, but
there's more than $12 trillion in this 401k money, which is why they want to access.
I mean, I can remember times when like Apple went into the Dow. It's like, oh, now you're putting it into the Dow, and then it just tripled from there. So, so I don't. And it could be a brief, little bit of a shakeout, and I don't know. If really rich people love private markets and have done well, it's a good idea to try to open it up to everyone. But the timing might not.
There are questions about the fees too, the fee structure, what it means for it. But yes, if they've outperformed over the long time.
Right. Cheese will be next.
Coming up next on Squawk Pod, Gary Cohn, the director of the National Economic Council in President Trump's first term, where he stands on tariffs, inflation, and monetary policy, including whether the economy is ready for the Fed's next interest rate cut, whenever that may be.
It feels like there is a decent argument to be made on either side of the equation.
Welcome back to Squawk Pod from CNBC with Joe Kernan, Becky Quick, and Andrew Ross Sorkin.
Stand by, Joe. His mic to you.
Here's Joe.
About an hour away now from the release of the June Producer Price Index. Joining us now, Gary Cohn, IBM Vice Chairman, former Director of the National Economic Council, joins us on set, as he really should, exclusively from time to time. Thank you.
Joe, it's always nice to be here with you.
Always good to see you.
What an introduction, right?
Yeah.
You saw. I don't.
Nice introduction.
It's not nice to be wanted. No, it's not. It's not nice to be wanted. That I want you here instead of somewhere else. It's not. Would you rather say, "Gosh, I wish you were on another show"? No, you wouldn't.
It's always good to be wanted.
And you were watching Langone, Ken, yesterday, and the Journal has never liked tariffs. Obviously, Wall Street Journal, they're classic conservatives. Ken does not like tariffs. But there's a feeling among a lot of classic conservatives that something needed to be done, and they've kind of been lulled into the idea that some of this is okay, almost accepting some of the tariff moves. This kind of threw me a little bit today, because it's the president wouldn't like the results of what happened in those numbers yesterday. They weren't horrible, but real weekly wages fell, adjusted for inflation, because of where inflation was. So inflation's up, wages are down. That's not what he wants. It's not what he was elected to do. And it's a reflection in large part from some of the tariffs, right?
Correct.
What would you advise the president to do with tariffs at this point?
So look, I think you made two really important points.
Really?
Yeah, two. Yeah, it's pretty good start.
Wow. I'm going to have to go back and watch the tape. Go ahead.
So look, one point is there is a understanding or view in this country that we need to control certain parts of our essential supply chain. You know, I always say if COVID taught us nothing else, it surely taught us how vulnerable we are on essential parts of our supply chain. So the fact that we're trying to move some of our most vulnerable pieces of our supply chain that can shut down our U.S. economy and move them back to the United States. I think the vast majority of Americans and the vast majority of economists and the vast majority of business people all support that.
And that wouldn't have happened with pure market forces.
It would not have happened with pure market forces.
Okay.
So the good piece is we are starting to understand what are the essential things that need to be moved back to the United States
that might
to protect
cost
ourselves.
So,
It might cost us something.
Okay.
So that's the point that I think is interesting. The other point is, we are now at a point where we are collecting $30 to $40 billion of tariff revenue a month. And everyone's boasting about, the $30 to $40 billion of tariff revenue a month. The one thing I think we all will agree at is there's no free lunch. Someone's paying the $30 to $40 billion.
Yeah.
And ultimately, it is going to end up being the consumer that pays that money. So for a short period of time, maybe the business is eating it. So if you're an importer and you're Nike or you're Apple, you may be eating it for a short period of time. If you're the importer, you may be eating it for a short period of time. But that's an unsustainable business model. And you've got your shareholders and you've got your banks and you've got your debt covenants, and you have to abide by all of the restrictions that you have. So ultimately, you're going to be forced to pass those tariffs down into the system. And unfortunately, the consumer is going to eat them. And I think yesterday's numbers gave us a little hint. And by the way, I never get too excited over one set of numbers. I always warn people, it's a set of numbers. It could be completely different next month. So we have to wait to see what the trend is. But when you see, things that we know we're importing, like toys, like appliances, like paper products, all showing close to 2% inflationary pressures, we have a pretty good idea that the underlying product is probably not going up.
But the journal doesn't even argue that the problem is inflation, because it says it's probably a one-shot deal, doesn't necessarily go into services, doesn't necessarily, but it is a tax. It is a tax, and when you tax something, you get less of it, usually.
Well, when you tax something, you get less of it.
And it costs someone somewhere.
You affect people's buying power.
Yeah.
And if you're on a fixed income, you have less disposable income to buy goods because
and those
goods are more expensive. And we're therefore affecting the part of the population we least want to affect.
Exactly.
Which is the hardest working individuals. It's a very regressive tax that will force people to choose between what they're able to buy, what food can they put on their table, what can they do to improve their home or not. You're forcing consumers to make very difficult decisions as this gets passed along.
Here's the question. I think I was concerned in part because so many CEOs would come on and say they were concerned about the uncertainty of taxes, and that the uncertainty was going to prevent them from making investments. The things that they wanted to do, they were going to sit on their hands and try to figure out what was going to happen, and then they'd wait. It does not appear, at least the way the economy is going thus far, unless it's, we don't know the other side of it, that somehow people are stopping. You look at all of the AI investments that are taking place. You look at there's just even some of the M&A activity that your former firm Goldman Sachs is reporting.
Johnson & Johnson was on this morning talking about $55 billion in investments.
Look, maybe there'd be even a greater tidal wave of investment if this uncertainty didn't exist. But how do you think about that?
The uncertainty piece that we've all been talking about. So look, the uncertainty piece breaks down into a bunch of different silos. So we had the one big beautiful bill uncertainty piece. Now the bigger uncertainty in that bill was really what was going to happen to the personal income taxes. The vast majority of the corporate taxes were law. They were not going to expire at the end of this year. Right. But on the flip side, there were about $4.5 trillion of tax relief on the individual side, meaning that every taxpayer's rates would go up. Yes, we would bring back the standard deductions, we would bring back the itemized deduction, we would bring back all the complexity of filing tax returns. And I think that had a a huge effect on the way people were thinking about what their after-tax spending would have been or could have been if Congress was not able to roll those rates forward. Not only did they roll those rates forward, they actually put back some of the stimulative for lower income families that was in the original bill, which I think are very good and supportive. There's enhanced child care credits, there's enhanced credits for families. So look, we end up in a place from the tax standpoint, from the income tax standpoint, where I think that variable is off the table. We know what it is, it's baked, it's signed, nothing's going to change, and people cannot say, I don't understand what's going on with taxes at this point. And in fact, on the business side, there was more incentive in there to go out and manufacture and build in the United States. You got enhanced depreciation, you got enhanced R&D credits. Right. So all of the things that you would want or need to manufacture and build in the United States were included in the tax bill. So now we get to the point where I think we were starting with Joe is, okay, if I'm going to go build and I'm going to manufacture in the United States, okay, I'm starting maybe to understand the cost of manufacturing the facility. Once I manufacture a facility, I've got two inputs. I've got to bring labor into the facility, right, and I'm not sure what my labor costs are going to be, and I have to bring raw materials into the facility. And a lot of those raw materials are not manufactured here in the United States. And even if we say we will manufacture those here in the United States, realistically, that's a 5+ year project. And what we're seeing on some of these deals where we're making deals to manufacturing things in the United States, like magnets, the price is dramatically different than where the current clearing price of a magnet is today. Right. So am I going to build a factory? Am I going to
Do you think these announcements aren't real then?
Things are real, but the question, am I going to go borrow $1 billion plus to build a factory if one of my major input costs just doubled? Right. So you have to assume my final good has to sell for dramatically higher.
Or you have to figure that it's cheaper still to manufacture it here, given the tariffs that are going to be imposed on anything you manufacture.
You'd have to make that rule. So you have to make that adjustment in your mind, but knowing that manufacturing takes 5 years forward from now,
you don't know
and
where
predicting what
stand.
the tariff is when it's not law.
Right.
When it's not been law, it's not gone through the Congress.
Pleasure of the president.
That's a tough thing as a board of a director. As a board would sit there and say, is this a prudent thing to do for our shareholders?
Does the market make sense at these highs? Do you think that momentum can continue? Because we've had a lot of people over the last few days who say, hey, the market can grow into this and continue to push even higher.
Well, right now we are seeing the vast majority of spending in what I would call the AI-related and ancillary spaces. We're seeing it in the power grid, power formation, power generation. We're seeing it in the warehousing of CPUs, GPUs. We're seeing it in the building of these massive buildings. So look, the AI wave right now and the demand for compute power is extraordinary. And it's really important in the U.S. economy. And that piece of sort of demand itself, which seems insatiable at this point, it seems like we cannot build enough data centers fast enough, which we can talk about at some other point, because we've never seen a period in time where we don't overbuild at the end. That demand for AI infrastructure today is having a dramatic impact on sort of the construction market, on the labor market, on the goods and services that need to go in to continue to build out that industry, which will be very important for the United States.
Gary, so I'm still back to this. So it's not necessarily inflationary, but it is a tax. So would you cut, right? I mean, taxes are, they cause a slowdown, and if it's not inflationary, do you think that Trump's on to something with the cut, or do you think the Fed's in the right position right now?
So look, when you talk about the inflationary side, there's always an argument here. If you take a product that cost X and put a 100% tariff on it, it now costs 2X. Yeah. But you only do it once. There's a price change. Okay?
Price change, but not
price
inflation.
change. It's not going up month after month after month after month.
Right.
So the way inflation data is calculated, we could argue if this is right, you will see a bump in 1 month. But the next month, there will be no inflation in that product.
So yes, you'd cut?
So there'll be no inflation in that product. So you have to understand the price of the good and the amount of disposable income that people would have would go down. It would go down because they'd be paying the higher price.
Right.
So when you get to the Fed and you get to the Fed policy, I think ultimately you're looking at data. You're looking at inflation. I mean, they've got their dual mandate. They have a very clear dual mandate, which is, stable prices. We interpret stable prices to be 2% inflation, and we look at full employment. Right now, one could argue that we are at stable prices. Yeah. You could argue that they were more stable 2 days ago before we got yesterday's data.
Right.
We'll get a little bit more data today. But still, even with yesterday's data and CPI 2.7%, like I said, it's one number. We were 2.4% before that. And we see the employment numbers continue to be relatively strong. It feels like there is a decent argument to be made on either side of the equation.
I could debate either side.
I think there's a decent argument. Now, look, no one's asking me, but if someone said, what would you personally do, Gary? I'd probably lower interest rates a little bit. I'd lower them 25 basis points.
I'm with you.
And see what happens. I don't think there's a lot of risk to lowering rates at this point, 25 basis points. But again, we're lowering the front end of the curve. The front end of the curve right now is relatively low. There's more demand for short-term treasuries.
Looks okay, though.
The long end's going to trade where the long end trades.
I know we got to run. I'm just curious, I don't know if you saw the story we were debating earlier in the Wall Street Journal about 401ks getting into private markets, whether you think that's a good thing, these semi-liquid products, what you think that should be.
I think it's a great thing. I think that we should give people with 401ks access to products that will perform well above market expectations over longer periods of time. And I think the history of private markets is that they have outperformed through the cycle. And a 401k is a perfect vehicle to put something like that in because you more or less buy it, you somewhat forget about it,
hopefully,
you own it, and hopefully the duration is you'll buy it when you're 30 years old and you can't get the money out for another 35 years.
Right.
So you've got 35 years of compounded appreciation.
Does that change the marketplace so more companies stay private, or does it change the marketplace so more companies go public?
I think at the end of the day, it probably will have very little effect on companies going private and companies going public. You can buy a private company in a 401k and have it go public and end up with shares delivered to you. I don't think the owner of the 401k cares. They actually might like it. At the beginning, they bought something private that they'd appreciate it a lot, and at the end, they got something very liquid and transparent that they could easily liquidate. They don't have to wait for someone else to liquidate. If you would tell people that would be the normal path of trajectory, that you're going to buy something private, and by the time you're able to liquidate this 35 years later, or 30 years later, or 25 years later, most likely it will be a public security that you can.
I just think it creates such a larger pool of money for private assets, which therefore would more likely keep them private for longer, or they'd sort of hot potato as even a private for longer kind of scenario.
There's going to be rules on private funds and private securities to how long you can keep them. I don't think you'll see asset managers keep private companies private for 30 years. I mean, that to me would not be the ultimate
outcome. Are you as bullish on the future as Ken Langone?
I don't know if I'm as bullish as Ken. But we all love Ken.
You work with the president. You know him well.
I know Ken well,
Do you think, like Ken thinks, that Trump's going to be remembered as a great president?
Look, I think Trump will be remembered as a president with really unique ability to understand the policy situation in the United States. And he'll be remembered as someone that attacked some of the thorniest policies that people were not willing to deal with. Right. And as time goes on, people will remember the policy change and the effect. They will not remember how we got here. And I think as time goes on, the policy effect is very bullish for his brand and his reputation. And having forgot how we got here will help his brand and reputation.
There's like sees a problem and he's like a bull in a china closet,
Yeah.
basically. Right? Things break.
Yeah. But at the end
Maybe
of
with
the
a hammer?
At the end of the day, presidents are remembered for what they got accomplished or
Right.
what they didn't get accomplished. And I think we will see what he's done, with getting the taxes extended, what he's done in the Middle East, what he's been able to do with foreign policy, what he's been able to do with foreign leaders, the fact he's been able to get NATO to pay for their own security as well. There are a lot of very positive things that if you were just writing the list of things that the Trump administration has gotten done, there'd be a lot of things in the very positive column if you could only write concrete things.
Yep.
If you were writing emotional things, people might write a lot of emotional things in the negative column, but guess what? 10 years from now, 20 years from now, 30 years from now, the only column people are going to remember is the column of actual achievements.
Yeah. Well, we've seen this movie before. We were in Davos, and he was like the belle of the ball, and then COVID hit. And things were going well. Remember how well they were going?
I remember.
Thank you.
Thank you.
Gary.
Thank you.
Thank you, Gary.
Next on Squawk Pod, hosts of the Acquired podcast, guests like JP Morgan's Jamie Dimon, Starbucks' Howard Schultz, and Nvidia's Jensen Huang have helped build their listener base to 1 million strong. Ben Gilbert on how they did it.
We never did any marketing. We never did any sort of paid growth. We were willing to take a really long time to build a listener base and build the business.
And David Rosenthal, 10 years into a project they started just for fun.
For 3 years, this was a hobby. We didn't even have a legal entity.
Good things take time.
Took us 20 years to be more than a ticker with, some talking heads. It has never been sexy.
Speak for yourself.
You're listening to Squawk Pod.
Up and Andrew, Q.
You're watching Squawk Box right here on CNBC. I'm Andrew Ross Sorkin along with Joe Kernan and Becky Quick. Acquired is the hit podcast that breaks down the stories and strategies behind the world's biggest companies, from Apple to Berkshire Hathaway. It now reaches more than 1 million listeners per episode, and last night hosted its largest live recording ever at Radio City Music Hall. Joining us right now are the co-hosts of that podcast, Ben Gilbert and David Rosenthal, and it's great to see you. And I should say I made a very brief little cameo last night, which was kind of fun.
Been about 7 hours since
Well,
we
you
saw
guys
you
were up
last.
to what, 12:30 last night?
We're on 3 hours sleep.
Yeah.
And you had Jamie Dimon, and you had Barry Diller, and you had Meredith Levien from the New York Times, and you had Howard Schultz making a surprise entrance to this whole.
Which
And
was
we had Starbucks this morning.
Well, you might need that.
Yeah.
So tell us about the podcast business, because as Becky was mentioning just off camera, you guys have made this work in a remarkable way. You do these very deep dives. This started, 10 years ago now? I mean, how long?
10 years.
10 years. What was the genesis of it in the beginning?
Well, the genesis of it was Ben and I were friends, we were coworkers, and we wanted an excuse to hang out more. And for 3 years, this was a hobby. We didn't even have a legal entity. We had nothing.
No revenue.
Except we had a few hundred listeners, and we were like, this is fun. And somehow it became this.
And when you first started, was the plan just to do this, you were just trying to learn about the businesses and then just talk about it? And then did the people who you were talking about start to call you? What?
So I was starting companies, David was investing in companies, and the whole thesis was if we understand what made the great businesses really successful, then we should be able to apply that to our own work. And it turned out that over the next 10 years, we accidentally started this company. Acquired is our company, and we sort of tried to take as much that we can from learning of all the companies we've studied and bring it into our world at Acquired.
Okay, how often do the CEOs or the people that you're talking about call you afterwards and either say, I agree with you, or I completely disagree with your analysis of how this really happened?
We almost always get a call afterwards. The interesting ones are when we don't get a call afterwards. Almost never do we get a call that's saying we disagree. So we take the no calls as disagrees.
or Rolex did not reach out. It almost makes it better that Rolex didn't reach out because we made a big deal out of the fact that Rolex doesn't communicate with the press, and true to form, we didn't get the call.
Were you, I don't remember, were you nice? You were not nice to Rolex.
No,
we're very nice to Rolex.
I think they built an incredible machine, and they make great products.
Part of Rolex's whole ethos, strategy maybe, is they have no press communication, period.
You guys look at successful companies for the most part, and you're trying to figure out what makes them tick. So it's not usually a takedown of sorts, but you're just trying to figure out what the secret success is.
Yeah, we look at the extreme outliers that are ubiquitous today, that everybody knows, that feel huge, that have always been here. We try to figure out, at some point they were nothing. Where did that change and why? And what can other people learn from those inflection points in the business?
Okay, so is there is there like a thread here? If you had like 1, 2, or 3 things to say, just generally now that you've done this for a decade, about these successful companies, these outliers?
They're almost always founder-led. The founders are almost always wackadoos in some way, and they leverage that insanity, that way that they're 4 standard deviations different than the mean, into some incredibly high leverage thing that makes their company work. And every single one is different.
Some rule they break.
You asked a very smart question last night of Jamie Dimon, which I was listening for, which was, you said that you think that incentives play a huge role in everything. And you were talking to Jamie about why he made the decisions he did ahead of the financial crisis in 2008. And what were the incentives that led him to do that relative to everybody else and did they have different incentives? Did you think that you understood the answer there?
His answer was, he kind of took it to how he incentivized people in his organization.
Right, with Cohn.
I think the real answer here is Jamie is willing to think with a longer view than his peer set in the 2004, 5, 6 era. And his thinking was, if I'm trying to build a company that's in a great place 30 years from now, we're going to have to withstand at least 1, maybe 4 or 5 big drawdowns, wars, terrorism. Let's just bake it all in and assume we need that margin of safety and operate with that. Whereas everybody else was saying, I hope there's not a recession in the next year, and maximizing profit in the short term.
One of the things you've done, I think, is in a very good way democratize just information around business and understanding what makes a great investment, what makes a great company, which leads to the question we were just discussing in terms of the headlines in the last hour. There's a big move afoot to try to democratize investing even more through 401ks and getting people into private investments. You asked about private credit to Jamie Dimon last night. But more broadly, do you have a take on this situation? Do you think that folks should, in their 401k plans, have access to private investments?
Yeah, I mean, the mechanics of how you do it are above our pay grade to figure out. But one of the biggest things since the financial crisis is staying private longer. These companies, I mean, there's so much value creation in private companies now, especially in the tech sector where Ben and I grew up. Companies are now, what's OpenAI's current valuation? 300, 400 billion? That's all happened in the private markets. In the old days, it used to be you'd go public when you hit 50 million in revenue. And now it's like you go public when you hit 50 billion in revenue. And so individual investors are locked out of that.
What is the lesson for you? We keep talking about media and the future of this, what you're watching here. And what you've learned, do you have a take on sort of where all of media ultimately goes? Do you think it all becomes a podcast, all becomes a video podcast, a streaming service? Would you be investing in legacy media yourself? What do you think? You want a show on CNBC? We can try to talk to some people.
It is great being here. I feel like I'm in the center of the universe, I will say, after watching hundreds of hours of this show. All media has a job to be done. And I think one thing that we learned from having a big piece in the Wall Street Journal last year is there's a lot of talk about the creator economy and about new media and about podcasts and about you can do this stuff on a shoestring budget. When there's the right piece in the right publication with massive, massive reach, it's game changing. Nothing has ever changed our business the way that a Wall Street Journal piece had.
That's amazing. I mean, because I've been trying to figure out how you guys figured out how to make this work. This is what everybody in media is trying to figure out. The idea of going deeper and longer and getting to do one thing a month, that is what everybody dreams of, and it's so hard to be able to find a way to do that. How did you figure out how to monetize it, especially when you just kind of did it by accident?
Well, it's like Jeff Bezos says, you get the shareholders you ask for. We got the listeners we asked for. We never did any marketing. We never did any sort of paid growth. We were willing to take a really long time to build a listener base and build the business, in part because we never actually thought it could turn into something this big. So every listener is word of mouth brought by someone else.
And by the way, it's 1 million listeners who are the most coveted demographic out there. These are very wealthy, very,
it's business executives making
big decisions.
decisions.
CEOs and C-suite people.
It's about business.
Yeah, it's people who are
I
excited
mean,
to
the most
listen.
boring. We've been. This show's 30 years old this year.
Congratulations.
It took us 20 years to be more than a ticker with some talking heads. So it has never been sexy, never been. But we keep.
Speak for yourself.
But you have an incredibly loyal listener
You're
base
not
who are
Adam
here
Driver.
every morning.
I think I'm talking to Adam Driver. And what were you? You've been doing this for 10.
He's much taller than I am.
You weren't in Star Wars. And you've been doing this 10 years.
10 years.
10 years.
When did you start? Do you like looking youthful? I would like, if I were you, I would like looking.
It didn't play for a long time, and now as I'm getting older, it plays much better.
Because you're like a genius, I think. That's what it seems
At
like.
looking youthful.
Yeah. Exactly. All right, so you're not, okay. I needed to clear those two things up. He's of age, and he's not Adam Driver.
Ben and David, want to thank you both. Appreciate
Thank
it.
you for
It's very
having
good to see
us.
you this morning, and thank you for waking up early and staying up late
Thank you
last night.
for joining us last night.
And it was very, very cool to be with you last night. By the way, a good time, not just to promote Acquired, but also maybe to tell you that you can get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app. You see that segue going on there. You can find us on YouTube and everything else. Listen anytime.
You heard him. Hit that follow button wherever you're listening now. If you're already a follower of Squawk Pod, thank you. And for the full 3 hours of our Squawkin', tune into CNBC on weekday mornings at 6 a.m. Eastern for more Joe Kernan, Becky Quick, and Andrew Ross Sorkin. That's it. Have a great Wednesday. We'll meet you right back here tomorrow.
We are clear. Thanks, guys.